By May of 2026, major indices like the S&P 500 and the Nasdaq Composite are sitting near all-time record highs. Investors are pouring billions into companies like Microsoft, Amazon, and Meta, riding a massive wave of AI development. On paper, the broader economy supports this optimism. National GDP growth is holding steady at roughly 2%, and unemployment rates remain notably low. Yet, if you ask the average consumer how they feel about their finances, consumer confidence is deeply shaken. For millions of people, the daily experience of paying for groceries and rent feels like a recession is already here. Top economists are observing this disconnect and issuing aggressive warnings. Many have assigned a high probability to a severe economic recession hitting by late 2026. The traditional headline metrics reporting growth are perfectly accurate, but they are relying on mathematical averages. Those averages are blending massive tech sector windfalls with deteriorating working-class savings, masking a systemic pressure cooker about to blow. The mechanical cause of this pressure is inflation. After a period of cooling down, everyday prices have reversed their trend and are persistently stuck at roughly 3.5%. This animated map tracks where inflation originates. Driven by global tensions, oil prices spiked 50%. When fuel surges, transport prices instantly inflate. That hike bleeds into agriculture, raising food costs, and simultaneously drives up baseline overhead for domestic manufacturing. Because oil affects the absolute bedrock of the supply chain, this specific type of inflation hits survival goods. It cannot be easily ignored, out-earned, or budgeted away by an average household. This building is the Federal Reserve. Their primary response to this persistent inflation is to keep interest rates punishingly high for an extended duration. This high-rate medicine acts as a poison for average citizens. Anyone looking to buy a house faces soaring expensive mortgage costs, while consumers relying on credit cards are hit with crippling monthly interest. The broader business ecosystem absorbs this blow as well. High borrowing costs make it difficult for small businesses to finance expansion, and early-stage startups struggle to raise the necessary funds to survive. High prices colliding with high borrowing costs create a K-shaped economy. The upward arm represents wealthy individuals earning massive returns in the AI stock market. The downward arm tracks middle-class earners burning through debt, their purchasing power plummeting to afford daily living. The widely reported strong U.S. economy is a mathematical illusion. It averages the skyrocketing wealth of the top tier with the sinking reality of the working class, leaving two completely separate financial Americas existing simultaneously. The extreme tension of this K-shaped fracture isn't just a social problem. It threatens to pull the broader financial infrastructure apart. Behind the scenes, the economy is being propped up by record-level government debt and a massive expansion in private credit markets. Because traditional loans are so expensive, high-risk borrowing has moved into these less regulated private sectors, creating a secondary layer of debt that is difficult for the Fed to track or control. In the best-case scenario for late 2026, supply chain inflation finally cools off. This gives the Federal Reserve room to cut interest rates, relieving the pressure on consumers before they reach a total breaking point. But the worst-case scenario becomes more likely if the consumer floor falls out. If middle-class spending collapses under high interest and inflation, the earnings of those high-flying tech companies will eventually miss their targets. In an overvalued market, a single missed quarter can trigger a 20 to 30% correction, turning a consumer struggle into a full-scale recession. The economy resembles a car traveling at top speed while the engine overheats. Navigating 2026 requires abandoning the idea of a single, generalized economy and preparing your finances for a deeply fractured reality.